Hey everyone, I hope you're doing great. Today we will talk about what you are looking for and what you are looking to get answers for. Today we'll talk about what the venture capital means, and you will also get all the contact information that you need to have in order to connect with venture capitals that has already been interacted with similar deals or similar projects as yours. At the same time, you will also get successful projects or companies that have already raised capital from VC before. So you will have all the knowledge, all the needed information that you need to have in order to communicate or engage with VCC or to have the access to any venture capital later on. At the same time, you will also understand the stages of the investment, which is the seed, the series A, B, and beyond. At the same time, you will also understand what the VCC they look into, what they look into when they want to invest into a startup. They're looking into the market size, traction, team, and scalability. We'll talk about all of that after every section. So you will get also contact information to direct VCC, so you can also engage with them and see if they are willing to invest into a startup. If you have a promising startup that has a unique concept to the industry. So let's dive in and let's get into it directly. So that's what you will gain from today's video. If you are willing to invest the next 15-20 minutes to learn all of this knowledge to scale up your startup and to raise capital for it, so you are one of those who will make it. If you are not willing to do that, so it's up to you. You can just keep away and keep scrolling around. So let's get into it directly. So how venture funds are structured. So let's take a look. Venture capital funds are financial vehicles that bring together investments from limited partners, which it calls for LPs. So when someone telling you what the LPs means, so it calls for the limited partners, okay, and are managed by general partners. General partners, it calls for GPs. All right, GPs, general partners. Limited partners, it's called for LPs. So if you are new into the financial industry, so you understand these symbols, and you understand what this means. So when everyone telling you anything about what the limited partners mean, so you understand that it means LPs. When someone telling you what the GPs means, you directly got it. It means general partners. That's what you can get from these points so far. So now let's identify them. Let's get into it and let's dive into what these principles means. So limited partners, it means LPs, as we said. Who they are? LPs are the investors who provide most of the capital in a venture fund. Okay, they can include institutional investors, which it call it for pension funds, endowments, and sovereign and wealth funds. Okay, that's who are these investors. And at the same time, high net worth individuals or family offices. Okay, so LPs, what the LPs are, okay, you got it right now. Pension funds, sovereign, and wealth funds, that's what the LPs are, along with high net worth individuals and family offices. All right, I hope you got it. So LPs are the passive investors. They contribute money but don't take part in the day-to-day decision making. All right, so I'm giving you an example right here. The Yale Endowment Fund, a prominent LPA, has heavily invested in venture capital over the years, generating significantly return and founding several funds. You got it? I hope not, because if you don't, I will explain to you. So now I'm telling you again, LPs are passive investors. Okay, so what the LPs means, as I'm telling you right here, limited partners. Limited partners are passive investors. Okay, they contribute money. But don't take part in the day-to-day decision making. All right, so they have no power to take any decisions. They are just leaving their own money with the venture capital right here, that they will invest their money, all right, instead of them, correct? They will invest their money, all right, into startups that they see that they can get return from them, correct? So that's what they are doing. They are only putting or leaving the money with the VC, all right? So that's what you can get it here. Okay, example here I'm giving you, the yearly endowment fund, a prominent LPA, which is limited partners, has heavily invested in venture capital over the years, generating significant return and funding several funds, but they have no power, or they have no decision making, or they have no access to do any decision making in the day by day projects. Let's take a look on how yearly endowment fund investing. You can see right here what they are investing into. So now you can understand how they are investing into, which projects they are going into them. Okay, you can understand exactly what they are investing into. Okay, you can see their allocation right here, and you can see their project revenue right here. Okay, you can understand how they are working deeply by that. Now let's get into the second one. And right here in this image, you can see how they are investing. You can see how the endowment fund they are investing. All right. You can see operating budget revenue for the 2025 and endowment fund allocation for 2025. You can take a look on that. All right. At the same time, you can also do some research on endowment fund investing. They are investing in very lucrative way in the investing industry. So now the second one, we have general partners, which is called for GPs. What does that mean, GPs? GPs are professional fund managers responsible for operating the fund. Okay, so now it sounds like, all right, now we're coming into the decision makers, correct? Now we're coming to someone who will do the decision right here instead of the LBS will do that, correct? So that's exactly how that's going on. The GPS responsibility, sourcing investment opportunities, conducting due diligence to assess startups. So they are taking a look on the startups that they're looking to invest into. If they understand what they're talking about, the team behind it, if they have a unique concept to the industry, if they have a long-term vision, if they have a short-term vision, if they're looking to expand in multiple industries, if they will have multiple locations, if they will have franchises. So all of that, it matters. All of that, it pack it up into the asset of the startup. That's what they are looking into. And most of the time, they look into one thing, one main thing that you need to take a look on and you need to understand deeply is when you are into the industry and you're taking the hits, you're taking daily hits from the industry, and things isn't going as you have already planned, and you have already spent your money onto the marketing, but you are not getting the interactions that you have already planned to get. When we can see you from there, would you persist? Or would you just stay around and just do something new and start rising for a new project? You got it? That's what they are looking to. They're looking to see the mindset of you, the persistence of you, and what's your energy. All right? Venture capitals, they are investing into people more than they're investing into any other startup or more than any other concept or unique product. Okay, and you showing that by what you have done before for previous experience. Okay, and you showing that by how you are engaging with them. Okay, you showing that you paying attention of what you are telling them. Do you have metrics? Do you understand your numbers? Do you understand your lifetime value, how it could be? Do you understand how you will get customers? Do you understand how much you will spend to get the customers? Do you understand for how long time your customers will stay with you? Do you understand all the metrics? Do you understand what the competitors they are doing and what you will do later on to make sure that you will beat them for the long-term run? So all of that matters. Do you understand how you can build your brand? Do you understand how you can do the marketing side? Do you understand how you can build your advertising side? Do you understand? Do you understand what's your target audience they are looking to right now, and what they have already told their own selves that they need to have solution for? Do you understand? They want to understand uh, all of these questions, that they will not ask you these questions directly, but they will hear your answers from what you're gonna tell them by your own self during the first call. Okay, so let's get into it. At the same time, with their responsibilities, managing investments and supporting portfolio companies, generating return for the LBS. All right, so now we understand something. All right, as I told you, GBS, they are responsible take to take decisions. All right, LBS, they are only responsible to do the investment and leave their own money with the GBS to do the investment for them and get return from them every year. Do you understand? I hope it would, because it sounds so simple right now. Right now, let's take a look on this example. Example: Benchmark Capital GBS, just as Bill Gorley. If you don't know Bill Gorley, so you need to do research on that, because he is a big name in the financial industry. Here's a picture of him. Bill Gorley have been pivotal signing and supporting companies like Uber and Twitter. So Bill Gorley, he's one of the GBS, correct? So what's his main thing is to identify the startups that has a long-term vision, all right, and they are looking actually to do huge numbers to get return to the LBS. You got it? Here is Bill Gorley, all right. He has already been involved in the Uber and Twitter early on. So this guy or this man, he understands the financial industry deeply, and he understands when he wants to do the investment or when he will tell you, I'm not interested and never message me anymore. You got it? You can do research on him. You can also watch his interviews. You will gain some knowledge. You will understand his mind more deeply, and you will understand what he's looking to when he will do any investments. So you can understand how the venture capital industry works deeply, especially specifically with the GBS, because it's GBS who would take any decision to invest into your startup, not the LBS, and you need to understand the GBS more than the LBS. Right here, you have also some venture capitals that they are investing into startups. You can also take a look on them and try to engage with them. If you have interesting concept, interesting team behind the project, they may be engaged with you. You will have all the links for these venture capitals in the Google document. You will find it in the description directly. You can just download it and start to engage with them. Now let's take a look on how they're making their own money. So they take in management fee. GBS typically charge 2% annually on the total fund size to cover operational expenses. All right, so they charge 2% annually to cover to manage the total fund. All right, so the total fund size, that's what they're taking 2% from. Okay, so management fee 2% annually. The management fee is designed to cover the operational costs of managing the fund, such as salaries, due diligence, and administrative expenses. It is charged on the total fund size, regardless of the fund's performance. Okay, so they don't care about, all right, you have already made money, you haven't made money this year, but you have already left your own money with them. They will charge 2% on from the funds that you have already left with them. All right, they don't. If you have made money with them or not, they will charge you 2%. Okay. And if you take a look on how things going on, if you are an investor right now and you have already left your own investment with them, if you take a look on the facts, so you will also lose 2% inflation every year, correct, to the bank, correct? So why you are not losing it with venture capital is that they may making any profit on your money. correct? So that's how you can see that if you have any other investments that it could actually generate to you over 10%, so that may be way better for you. But I'm just giving you like example on how you can think about the management fee, which is, as I can see it, is not a lot. 2% is not a lot for the whole year. It's not a lot at all. So example calculation, let's take a look on it. Suppose, so let's assume that the total fund size is 1 billion. All right, let's assume that. Okay, so the annual management fee would be 2% from the 1 billion. So from the 1 billion, they will take from you 20 million. Okay, for the whole year. Okay, that's what they will take from you. So if you have any other investments or any other ways to generate more than 4% per year, so you can just invest your money into the other projects. But here you are most likely to make more money on these 1 billion that you have, because they will invest your money into other projects, because that's not the only way that they making their money with. Not only the management fee, they're making their money on other way too. I will give it to you right away. So over a typical fund life of 10 years, let's say that you have already left your money with them for 10 years, this could amount to 200 billion in total fees. So they will take from you 200 million over 10 years if you have already left your money with them for 10 years, if we say that. So now let's take a look on the second way on how they're making money. Okay, so they're making their money on the carried interest. What that means? GPs earn 20% of the fund's profits once they surpass a predefined return threshold. So once they're making the return that they have already talked with you that they will do, or they have already discussed with you that they will do, and they have already done this profit on your investments, so they will take 20% of this return. So now let's take a look on that, on how that works. So carried interest carry is a primary source of significant profit for GPs. They earn 20% of the profits generated by the fund after surpassing a defined hurdle rate, typically 7 to 8% annual return. So let's take a look on what that means. So there is something it's called for the hurdle rate. Let's take a look on what that means, so you are aware, you are waking. Let's take a look on that. So now I'm going to give you an example. Profit distribution. Example. So let's say the initial investment is 1 billion found invested in multiple startups. All right. Let's say that's what they have already invested into multiple startups. All right. The exit value after a few years, this investment will generate total return of 3 billions. Okay, they have already invested into many startups, and these startups, they will do exit in few years. And in few years, this 1 billion, it will be 3 billion, correct? So net profits, let's take a look on it. 3 billion, all right, minus 1 billion initial investment, which is that's the initial investment that they have already done. So they will have 2 billion in the net profit, correct? But let's take a look on it further. We have the hurdle rate adjustments. The hurdle rate adjustment is the minimum return that the limited partners, the LPs, must receive before the GPs can start collecting carried interest. So the LPs, they have already done a deal with them, with the GPs. They told them, all right, we will get 7 to 8% return on our money every year, all right? And everything that you're making over that, it's yours. But anything that you're making profit for the whole year, we're taking 7 to 8% return on our money that we have already left with you. Correct? You understand? So that's exactly how you can see it right here. So they giving the hurdle rate is to give the money back to the LPs. Okay? So the GPs can start to collect their own profits after they have already given out the money to the LPs. So if the hurdle rate is 8%, let's say that because we said the hurdle rate is between 7 to 8%, correct? If the hurdle rate is 8%, the LPs must receive their hurdle adjustment return first. Let's assume the hurdle rate is 1.2 billion total return. Okay, let's assume that. So now let's do the calculation on that. So remaining profit pool 3 billion minus 1.2 billion, correct? We getting 1.8 billion, correct? So carried interest, GPS earn 20% of the remaining profit. So the carried interest, it will be calculated as this way: 20% x 1.8 multiplied 1.8 billion, and what they will get from here is 360 million. That's the carried interest for the GPS. So they will get 360 million. You got it? So now let's take a look on how much they would make right here. All right. So they would make management fees over 10 years. They would make 200 million. So that's the 2% management fee, correct? The carried interest, they would make from the fund's profits, they would make 360 million after the startup has already done the exit. Do you understand? So that's exactly what I'm talking about right here. I hope you got it. I hope it becomes more easy, more simple for you, because that's what the main point of this video right here. So the GPS would earn 560 million over the life of the fund in this simplified example. Do you understand what I'm talking about? I hope you do, because that's the best way to explain that. And that's, I'm giving you an example right here. Example, in Sequoia Capital's fund structure, GPS benefits significantly when startup like WhatsApp exit with $1 billion valuations. That's what we're talking about. You have already got it if you have already paid attention enough. So the management fee provides steady cash flow, correct? While carried interest offers substantial upside tied to fund performance, making it the primary driver of profits for general partners, which is GPS, in the venture capitals and private equity funds. Okay, now here you can get also other venture capitals that you can connect with and engage with in order to raise up capital for your startup. You can find all of these links directly in the Google Doc in the description. So now let's take a look. Fund life cycle. Most venture funds last 8 to 12 years. The first few years focus on deploying capital and acquiring stakes in startups. That's what they are focusing on. They're focusing to own startups in the first years. While the later years, they're focusing on scaling portfolio companies and planning exits, so they can take their money back, or they can take their money back with the profits. Example, Andreessen Horowitz. He's a big name in the financial industries. You can take a look on him. If you also watch his interviews, you will learn a lot. 2008, fund targeted early stage investments. A decade later, they successfully have done the exits for companies like Airbnb. So he understands that he will invest into the early stage investments, which he has his own strategy to scan them and to get them. When he does that, he waiting for 5 years or 3 to 5 years. Then after that, he do the exit right there. And when he do the exit, they do the exit with many more, multi-hundreds of millions. So that's exactly how things going on. That's exactly what he have done with Airbnb. So now let's take a look on this. The stage of investment, seed, series, or B and beyond. Venture capital funding is divided into these next stages based on company's growth and needs. So you have the first stage, which is called for the seed stage. Seed stage is only to validate the idea, build a prototype, or launch a minimal viable product, which is called for MVP. Funding size between 50k to 2 million. Investors, angel investors, and micro VCS. Example, Dropbox have already raised 1.2 million in seed funding from Sequoia Capital to develop its file sharing platform, which later attracted millions of users. Series O propose what the main point from it is to scale operations, refine product market fit, and grow customer base. Funding size 2 million to 50 million. Investors large VCS like AQL Partners and Anderson Horowitz, like what I have already showed to you above. Example, Airbnb raised 7.2 million in Series A funding from Sequoia Capital, enabling it to expand marketing efforts and refine its platform. Series B, the main point of it, to expand into new markets, hire key Thailand, and invest in instructors. Funding size 50 million to 50 million. Investors, growth stage funds, and prominent VCS. Example, Pinterest secured 27 million in Series B funding, which it used to scale the platform, and they have done the advertising model by that. Later stages, so after that later stage, what they call it for Series C and beyond, the main point from it is to achieve market dominance, explore global expansion, or prepare for EPO, which is to go public. Funding size 50 million to hundreds of millions. Investors, instantial investors, large VCS firms, and private equity funds. Example, Stripe has raised 600 million in Series G, a round which it used to expand globally and solidify its vintage offerings. Then after that, you go into the exit strategies. Companies in later stages aim for liquidity events such as ABOs or excavations to return profits to investors. Example, WhatsApp was acquired by Facebook for 19 billion, delivering massive return to its to the early investors, including Sequoia Capital. So what they are looking to, what the venture capitalists they are looking to into value startups. So I will tell you right away. Market size, they look into the market size. VCS invest in companies targeting large scalable market. A bigger market means higher growth potential. All right, so you need to have a big market. That's it. The bigger your target audience, the better it gets for you. The less your target audience, the harder it gets to you to raise capital. All right. Example right here. You can see example right here. Uber's total addressable market for global transportation services was estimated in the billions, which convinced early investors like Benchmark Capital of the startup that he is, because it has the potential to go big in the future, in the near future, and that's what we have seen. Traction was also taking a look on is the evidence that startups product or service had demand measured by users growth. Traction evidence that startups products or service had demand measured by users growth, revenue, or partnership. Example, Slack showcased exponential user innovation in the early stage, helping to square Series A from external partners. Team, the founders' experience, vision, and ability to execute are crucial. VCS often beat on people as much as ideas. We have Tesla. You know about Tesla. I don't need to go through it. I will go faster right now just to respect your time and respect my own time. Here you can also find other VCS that you can also take a look on them and connect them later on. You can also find all the links in the Google document directly in the description. What they also take a look on is the scalability, how scalable is the industry and the market is for this startup. Okay, startups must show they can grow rapidly without increasing the cost of the advertising always acquiring more customers. All right, so they need to show that upfront before they take any decision to invest into your startup. This often means leveraging technology or innovative business models. That means that you will have exponential technology or products that you need to offer to the market. That's exactly what it means. At the same time, you can also see what I'm giving you. For example, Zoom applied to investors with a high margin SaaS model, allowing it to serve millions of users with a minimal incremental cost. So that means you need to have low cost to have high margins. All right, if you have no margins and you have only gross margin, so that was what it will not make sense for them. What it means, what it makes sense for them is you will have net profit margin. So it takes their attention. So make sure to increase your net profit margin, not only the gross margin. All right, gross margin everyone can do it, but net profit margin is what matters, and you do that by decreasing the advertising cost or by your cost and increasing your revenue. So here you will also have links to other venture capitals that you can also engage with and connects to invest into your startup. I hope it was something new for you. I hope it was something important for you to take a look on, and I hope you got the whole idea of the venture capital industry. That was everything for today. Thank you so much.